If you're like most business owners, you spent 30 years building your business, but about 30 seconds thinking about how you'll actually exit it. In this video, I'm going to talk about an expensive mistake that costs you hundreds of thousands of dollars, maybe even millions at death or sale if you don't get this right. In the next few minutes, you'll learn what the Lifetime Capital Gains Exemption is. I'm going to help you understand what disqualifies you from getting this benefit. I'll also go through a real case study from a Winnipeg manufacturer who was about to sell his business for $2.5 million, but his shares didn't qualify for the Lifetime Capital Gains Exemption. However, after strategic planning and purification, he was able to save his family $270,000 in tax upon the sale of his business. My name is Quentin Chambers. I'm a financial planner and portfolio manager, and I build total wealth plans and manage portfolios for business owners, incorporated professionals, and affluent Canadians. And after doing this work for more than a decade, one thing to me is clear. People just like you are leaving real money on the table, and on this channel, I show you how to put that money back in your pocket. Here's the reality of business ownership that no one wants to think about. You've probably got 70 to 90% of your net worth locked inside of your business. Maybe it's a manufacturing company, maybe it's a professional practice, maybe it's a service business. Whatever it is, the business is your wealth. Now here's a question that often isn't asked until it's too late. When the time comes to exit, whether it's through a sale, transition to the next generation, or God forbid your death, how is that value going to be extracted? And how much is the government going to take in taxes? If you're like many business owners, the answer is you probably don't have a clear idea. You're hoping that it works out, you're hoping that the accountant will figure it out when the time comes, or you're hoping that the buyer will pay you a hefty sum and the tax situation will work itself out. That's not a plan, that's hope. And hope is the enemy of good tax planning. Here's what I see time and time again. You spend 20 or even 30 years building your business. At that time, your business is worth, say, $3 million, and that's when you decide to sell. Fortunately, because you've built a good business, it's able to sell, and you receive that $3 million. But one key concept that often isn't explained until you're actually going through the process of selling your business is the idea of the adjusted cost base of your shares. This was the amount that was originally invested to buying the shares to creating your business. But even if it's $500,000, that means in the case of a $3 million sale, there's a $2.5 million capital gain. And here's where it gets painful. Capital gains in Canada, 50% of the gain is taxable. So on that $2.5 million, $1.25 million is taxable income. This taxable income is then taxed at your marginal rate. So that means you might pay 45 to 50% depending on the province that you're in. That's potentially $560,000 to $625,000 in tax. On a $3 million sale, that's almost 20% of the proceeds going straight to the government. Now here's the part that makes it worse. The Lifetime Capital Gains Exemption should be protecting a lot of that capital gain. In 2026, you can shelter over $1.275 million of capital gains if your shares qualify. For many business owners, that can mean sheltering $300,000 to $400,000 in tax on a large sale. I've seen this many times for business owners who found me after a sale and realized that they've missed out on so much because their shares didn't qualify. Why? Because their corporations held passive assets like cash, investments, or real estate that weren't used in the business. When you have significant assets inside your corporation, your shares stop being a small business corporation in the eyes of the CRA, and you lose that lifetime capital gains eligibility. This is the part that surprises most business owners, and it's completely fixable, but you do have to plan ahead. The tax system is designed to encourage entrepreneurship. The Lifetime Capital Gains Exemption is a gift. Essentially, it says to you as a business owner, you've created value, you've created jobs, you've taken the risk, we're going to let you shelter a portion of your capital gains from taxes. But there is a condition. The shares have to qualify as small business corporation shares, otherwise known as QSBC in tax terms. For shares to qualify, the corporation has to be primarily engaged in active business income, not passive investment. If more than 50% of your corporation's assets are passive and not being actively used in the business, then those shares don't qualify and that lifetime capital gains exemption is gone. So here's how this usually happens. You're a successful business owner and you're running a profitable company. You start accumulating cash, that cash sits in the corporation, maybe it gets invested into a portfolio to earn some returns. Maybe it's held in case of emergency. And as a busy business owner, you think, I'll use this later, and then the years pass. The cash sits there, the investment portfolio grows, or maybe your corporation holds some real estate that's leased to third parties and not used in the business itself. Then we fast forward to year 20 when you actually want to exit your business. Now the business is worth $3 million, but the corporation also holds $2 million in passive assets like cash, investments, or real estate. In CRA's view, 60% of your corporation's assets are not actively used in the business, and your shares don't qualify for the lifetime capital gains. And suddenly it looks like you're going to lose hundreds of thousands of dollars in potential tax savings. Now, this is completely avoidable with early planning, and this is exactly what purification means. Which brings us to the solution and the time it takes to implement it correctly. Let me outline 3 exit strategies and how each one is affected by the lifetime capital gain exemption. Strategy 1 is family succession. You're not selling the business, you're transitioning it to the next generation. Your kids, maybe a family member. Now, this is still a capital gain. You're transferring your shares at a fair market value, which creates a gain between your original cost basis and its current value. In this case, the Lifetime Capital Gains Exemption absolutely applies here if your shares qualify. If they don't, you're looking at a massive tax bill just by transitioning it to the next generation. Now, this is potentially a reason to do what's called an estate freeze, but I'll touch on that in a moment. Strategy 2 is what's called a management buyout. Maybe you have key managers or a group of managers who want to buy your business. This is the same dynamic. You're selling the shares, there are capital gains, and the Lifetime Capital Gains helps buy out those shares if they qualify. Again, if they don't, you might find the business is worth $3 million to a buyer, but after tax, you only net $1.5 million because of the capital gains tax bill. Then we have strategy number 3, which is a third-party sale. You're selling your company to another company, like private equity or even a competitor. This is usually the biggest deal and the biggest tax impact. If the shares don't qualify for the Lifetime Capital Gains Exemption, you're looking at 6 figures or more in avoidable tax. If you're planning an exit, you should be planning at least 3 to 5 years in advance. And if you realize your shares don't qualify for the Lifetime Capital Gains Exemption, you can purify your corporation. Now, what does this mean? It means deliberately getting rid of passive assets before you actually make your exit. You can pay down cash to shareholders as a dividend. You can sell your investments that are no longer part of your strategic plan. You can restructure your real estate holdings, or you can do a share reorganization. All of these strategies are designed to get your corporation back to the point where more than 50% of your assets are actively used inside of your business. Now, obviously, there's a tax cost to purification. You might pay some tax on dividends or capital gains when you sell your investments. But if your exit is worth millions, the cost of purification is usually a fraction of what you'll save in the Lifetime Capital Gains eligibility. I also previously mentioned an estate freeze. This is a little more sophisticated, and you definitely need a lawyer and a good accountant for this. An estate freeze essentially locks in today's value for your business for tax purposes, and any future growth happens in the new shares that you gift or you sell to the next generation at a relatively low value. When you eventually sell your shares or pass away, you've frozen the capital gain at today's level. Everything above that flows to the next generation at a lower tax cost. Estate freeze are particularly powerful when you're in your 50s and you expect the business to grow significantly over the next 10 or even 15 years. But here's what matters most. This planning can't happen at the last minute. So I'm gonna walk you through a real world situation to give you a little better context. I had a client who was 58 years old running a manufacturing company here in Winnipeg. He'd been running his business for 25 years. He had plans to sell the business in about 3 years for what he estimated would be worth about $2.5 million. So we ran the numbers. Good news, the business was on track to sell for $2.5 million as projected, but the bad news, his accountant flagged that the shares might not qualify for the Lifetime Capital Gains Exemption because of those passive assets. So we did a full corporate analysis. The corporation's total assets were about $1.4 million, and when we modeled it in the sale, it became clear that share structure would be questioned by the CRA. So here's what we did. We spent the next 18 months deliberately restructuring. We paid out special dividends to the owner, he paid personal tax, and received the cash. He also sold off some small real estate in the corporation that wasn't critical to operations. We then optimized the investment portfolio so that highly liquid investments that could be seen as not essential to the business were reduced. By the time the 18 months was in, the corporation's passive assets dropped to $200,000. That's roughly 14% of his total assets. When the business sold, the shares qualified for the full Lifetime Capital Gains Exemption, and the business owner was able to shelter $1,050,000 in capital gains. At the time, this was the Lifetime Capital Gains limit. The remaining gain was taxed, but at a much more favorable rate because he didn't lose the entire Lifetime Capital Gains Exemption. The bottom line is that 18 months of purification planning saved his family $270,000 in tax on the sale of his business. That's not money that was reinvested into the business, that's money that stayed in his family. And that's a case for why this conversation can't wait. If you're a business owner with significant value in your business, you need an exit plan. I'm not saying you need to exit tomorrow, but you need to know your plan. You need to know how much you'll pay, and you need to know what your options are. The time to start this conversation is when you're 5 to 10 years away from your expected exit date. If you think you might exit at 65, start the conversation at 55. If you're considering a family succession, start even earlier. Estate freezes and share reorganizations work better when you have time to structure them properly. So if you're a business owner earning over $250,000 in your corporation, download my Business Owner Playbook. It's a short checklist of planning levers that quietly decide whether your corporation is working for you, so you can confirm each one is pulling its weight. Most business owners who run through this spot at least one area where they can keep more of what they've built. If you found this video useful, please hit that like button or drop a comment what topic you'd like me to break down next. As always, please subscribe so videos just like this one show up in your feed. Until the next one, take care.